Welcome to the Advanced Projections December 2021 Economic Snapshot. This is a short series of slides that are going to give our views of what's going to be going on in the economy and the markets for the next few months, and take a review of what the current framework is, the environmental framework. So here's our highlights. We had forecasted that the Fed was going to not only institute a script for the end of their tapering and beginning to move interest rates up, but also after 5 weeks accelerate that based on the significant drop in unemployment and the significant increase in inflation as they record it. COVID has been reinvading us with the new Omicron variant. I've just been discussing this with experts in the field, and they are predicting up to 3 billion with a B, new infections in the next 3 months. So that does not bode well for the planet. America is in somewhat better shape, but we have to be concerned about what's going to happen in the rest of the world as well. So pressures are going to remain on the economy. We have pressures on corporate earnings based on shortages of labor and supplies still remaining. The equity market bubbles had started to deflate. How long that's going to last, how deep it's going to go, we don't know. These ends or tops of markets are very noisy. So, you really have to look at a multi-week and multi-month trend to see where things are really headed. So the current environment, okay, so the COVID waves were nearly over as vaccines and boosters moved the USA much closer towards relief, but this new Omicron variant is really, we're already very heavily into the beginning of the large winter wave that Omicron is causing. The county right next to me is third in the nation in terms of new infections. And within a few weeks, of course, the fatality curve is going to move up in tandem with that increase in infections. Now, the recovery boom, we experienced a recession last year in 2020. We've been digging ourselves out of that hole ever since. The move from the bottom of the hole to up almost even with the end of 2019, that was the boom. And now we have to dial back on any expectations of further growth. Exuberance, the time for exuberance is past, we believe. GDP gains, gross domestic product gains, will be moderate through the end of this year and still remain muted in the first half of 2022. Inflation for this year is going to come in at 7%, plus or minus a tenth. And we should expect continuing 4 to 5% through 2022. This is just, basically the system settling out, the aftershocks of not just the sharp, deep, and quick recession, but, the ringing of the economic signal after, the Fed and the Treasury put in place their extraordinary measures to end the recession and basically keep the economy from collapsing due to, all the shutdowns that were going on with COVID. So we still face constrained labor supplies and supply chains. With this new winter wave, I don't see any quick relief in that area. The things that are constraining the labor supply and supply chains those forces are still in play. So they're going to take a while to work out, and it's not going to happen in 1 month or 2 months. It's going to take a while. This in prolonged concern about inflation as well. Those things are going to pressure corporate earnings in the second half. We have some projections here made by the FactSet organization, which show the growth that we've had in corporate. This is S&P 500, by the way, corporate earnings and the sales growth compared to what went on last year. And these are their projections for next year. I think these are still a little too optimistic. We will see as the first quarter progresses and we get the final numbers in from the fourth quarter of this year. So, those are the things we have to look out for in January and February. The equity market bubbles are still there. This represents the S&P 500 closing prices at the end of November. Things have moved down a little sideways since then, but we certainly should expect this line, the S&P 500 is not going to do one of these things in the next couple of months. The question is whether it's going to go sideways or whether we're going to start seeing a significant and prolonged decline. This is our version of the Buffett indicator. The dashed line represents the GDP, and it's been scaled such that normal behavior of the S&P 500 around the GDP they more or less track one another, and you can see the significant divergence going on, especially in the recovery phase, the exuberance going on with the massive federal injection of funds beginning right after the COVID recession began. Here's our 6 standard indicators. 2 indicators remain red. The stock indices, as we just discussed, are deep in bubble territory. Our precious metals ratio still shows rhodium well ahead of gold, and that keeps us in the red there. Yield curve is looking normal. The Federal Reserve stability indicators and their own recession indicators are green. The money supply for now is still expanding, but the Fed is going to be winding that down between now and March. And leading economic indicators are more or less stable, growing a little bit. But again, we don't know what effects the combination of a new COVID wave and the recent Fed decisions are going to have on the markets and corporate planning. So we don't know if the leading indicators are really going to stand up well. The sources for the leading indicators certainly are not pessimistic at all at this point. So they expect continued growth and improvement in leading indicators in 2022. We're taking a wait and see attitude on those things. So here's our projections for a 1-year economic timeline. Fourth quarter of this year, employment continues to approach full. 4% and below is full employment. When you drop into the threes, that's where the focus of the Federal Reserve and corporate planning starts to look at, all right, we have to deal with inflation and price stability now rather than trying to, get more people into the labor force. And what's also happened in the last month is the labor force participation rate has slowly begun to turn positive again, which alleviates Federal Reserve concerns about full employment. They're figuring that, that turnaround is going to work in tandem with the decline in the unemployment rate, and they don't have to focus on employment so much right now. We're still dealing with muted sales for new homes and autos. Supply chain constraints continue to limit those sales, and the markets for used automobiles and housing continue to inflate. The Fed tapering script will end asset purchases by the end of March, and we should be expecting rate increases soon, right after the first quarter. Energy prices will also constrain spending. So what we have to look forward to, and what's actually already happened, is increased oil and gas production will keep a lid on energy prices. We've seen gasoline come down already. Oil dropped almost 20% from its highs in November. So over the winter, of course, fuel consumption is high, so that kind of keeps the floor under energy prices. But as the Northern Hemisphere begins to experience summer, energy consumption declines somewhat, and production will overtake consumption at that point. We should also expect in the second quarter that the Fed is going to implement 1 and probably 2 interest rate hikes of 0.25%. By the time we reach summer of next year, hopefully we will be behind the Omicron wave, which could be pretty disastrous in this part of the year. But we can start looking at some cautious moves back to normalcy. The summer weather and easing supply constraints are going to have some positive benefits. The Fed continues their cautious moves upward on short-term rates, with probably a third rate hike near the end of this third quarter next year. So the distillation of all of that is the economy still isn't out of the woods yet. Equities markets remain way too far ahead of where they should be. Realities that should mute expectations for growth next year will set in motion during the next several quarters. And we seriously hope to see that COVID issues will finally decline to a tolerable level of risk, at least inside the USA, by the middle of next year. Thanks for listening. Please consider giving this video a thumbs up and subscribing to our AP Newsroom YouTube channel. There you can gain some temporary free access to the full member reports via the first link in our description. Please join our free economy monitoring group on Facebook with the link down below. And we're always interested in your comments, thoughts, and questions. So that's it for now. Have a great set of holidays here at the end of the year, and we'll be talking to you in one of our next videos very shortly, in about 2 weeks.